Kristina Hooper, the stock market survived Brexit and actually moved higher since then. So does that mean it's smooth sailing the rest of the summer?
Probably not. What we're seeing is the potential for more volatility. You've got the presidential election, plus you don't necessarily have a really powerful engine moving stocks higher. What we need to see is improvement in earnings to really power stocks up a lot more.
We'll talk about earnings because we've seen a few so far, especially the banks, which have been beating Wall Street estimates, and they're supposed to lead stocks higher, right?
Well, banks have historically done that, but all bets are off in this very unusual environment where monetary policy continues to control, really dominate asset class risk and reward profiles.
We'll talk a little bit about monetary policy and your view of the Fed. Right now, the 10-year Treasury yield is about 1.5%. So do you think we're going to get some rate hikes, maybe 2 of them by the end of the year, and that'll move that much higher?
Well, certainly the potential has increased for a September rate hike. Fed funds futures put it at about 18%. We think there's a very real possibility. I mean, certainly it is on the table for September. It's most likely not on the table for July, but very much a live issue for September, and it should be, given that the U.S. economy is doing quite well.
Well, a lot of people say that you're not going to get another rate hike too close to the election because that would make it political. So let's talk politics. Talk about the election and the campaign's impact on the market. Can it derail what we've been enjoying so far this summer?
Well, it could potentially. What we learned from the Brexit vote, well, we learned a few things, but one of the things we learned was the market does not like surprise. There was an expectation that the Remain voters would win, and when that didn't happen, we saw a short but very significant correction in the stock market. And that shock and awe is something that we could potentially see again if we see surprises. And certainly this presidential election season is very unconventional and has the potential to take a bunch of twists and turns before we get to the end of it. So I think we need to recognize that there's the potential for volatility there. There's also the potential for volatility with regards to monetary policy. If we don't see the easing or the continued loose monetary policy that most market participants expect, we could see some downward volatility coming from that.
All right, with all these scary thoughts in mind, let's drill down a little bit deeper. Which sectors should investors stick with the rest of the way? We saw utilities and staples and materials lead the market in the first half. What about the second half?
Well, the second half, investors should certainly still be focused on yield, but they could find yield in less traditional areas of the stock market, namely technology and healthcare. There are a lot of healthy dividend-yielding stocks there. Both sectors have missed out on a lot of the rally. They've certainly done fine, and we could see the catalyst for movement upward from an improvement in earnings by year end.
All right, well, thanks a lot for coming on and talking about it.
Thanks for having me.
And thank you for watching The Street.